Can you tell me, how did it feel in those moments, pulling the trigger on some of those investments when there was so much noise and so much uncertainty?
There's no doubt, given where the market level is consensus. Everyone's expecting this because markets have rebounded so hard, so everyone's expecting some normalisation, some layer. Now, it's quite peculiar to us that a lot of companies actually went and got more debt rather than de-levering this. It's going to be interesting to see how it plays out, because if we don't return to pre-corona levels, I suspect there'll be some interesting conversations with the banks. We've actually been investing in REITs in the last few weeks. They become so cheap. So what I learned was to have that plan before trouble sets in, because it'll get you to make some decisions, which in a couple of years you look back on going, that was actually a decent decision that we made. So right now, the market's rebounded pretty aggressively. Let's see, the market's factoring in normalisation of some sort of the economy, returns, and that provided, there was a really small window of opportunity in March where there's a bit of information vacuum. Governments hadn't reacted yet. Central banks reacted, obviously by providing liquidity, etc. So there's a very small window of opportunity where pretty much a lot of the market went on sale. You know, big discounts, everything got thrown out. It was pretty much indiscriminate selling. So that window is so small until the governments reacted. So if you hadn't done some work there and had a go at a few new opportunities or doubled up on your favourites, etc., you missed a bit of it. So the market's sort of pricing that in today. We did have quite a bit of indiscriminate selling across the board, so good companies were thrown out with bad companies. But there is going to be, out of this, some longer term structural issues were brought to a head, right? So it's going to have to happen, it's going to happen quicker. So companies were forced to pull out their restructurings to set their business up for a sort of maybe a new paradigm. They thought they might have 5 years to get to somewhere. They had to do it in 3 months and work on a plan for the next 2 years. So when it comes to our positioning, the way we looked at it was, okay, it's always determined by the value, where we're seeing the valuation support, where we can make some money by buying things where the market's overly discounting the outcome. So we looked for some sectors or companies that had short-term problems, as in, you know, had a sudden stop in the economy, right? So consumption dropped pretty quickly in a lot of sectors. So we're looking at those sectors where the short-term headwinds, but the companies in those sectors were going to be the long-term winners. So they were still in a good sector, and that company had good management, decent balance sheet, but they also used the market dislocations as an opportunity to press their advantage. So there's a bit of that setting up in the portfolio, but then also, as I mentioned before, the indiscriminate selling was quite broad in a lot of the cyclicals, as you would expect. And that set itself up where you could buy things which had fallen 50% in the space of a couple of weeks. And you didn't have to be very heroic about any sort of normalisation for you to make a return on your investment on those.
We'll come back and talk about some stock specifics in a little bit. I just want to stay high level just for a period of time. How are you thinking about the recovery process for the economy, underlying economies, given that there's been the big stop and people are trying to figure out how much of the workforce comes back, which industries are most impacted? Just keen to hear what your views are on the parts of the economy that you think look okay, the ones that you're more cautious on, where you think the road forward is a bit more difficult.
So obviously anything travel related, it's going to take a bit of time, and it's going to be very different within the sector itself in that I suspect, given that the COVID's still running around in other countries that are just starting that phase of it, the global travel bans will probably be in for a bit longer than we expect. And probably leisure will return, funnily enough, domestic leisure will probably return quicker than business travel.
Yeah.
So there's elements like that part of the will slowly improve. But parts of the discretionary sectors as well. So you've seen some of the winners, JB Hi-Fi, Harvey Norman, have done well out of the work from home move. But some of the other discretionary retailers will get a steady improvement as people get out on the streets, start to shop. Gaming, we think, gambling will rebound pretty quickly. And I think the evidence as live sports come back is you've seen betting pools rebound very quickly. But there's no doubt that this given where the market level is consensus. Everyone's expecting this because markets have rebounded so hard. So everyone's expecting some normalisation of some layer. So what the real question is today is not the recovery. You're going to have an element of recovery. Is that some sectors will take a lot longer to recover, and that's where the work needs to be done. More importantly though, some sectors may never recover. So they may go back to 60 or 80% of pre-corona earnings or sales, etc. So that's where the work's to be done now, because you've had the returns generated by a bounce in the market. You've got to try and work out you're in the right stocks, that you're not overestimating the recovery in those sectors. So that's where we think we are now. That's how we're trying to position ourselves.
That's the underlying and the fundamentals. The other big part of the equation is what's happening with central bank stimulus and interest rates, we thought they couldn't go lower. They found a new low here domestically, and there's all sorts of stimulus being pumped into the economy from offshore. How does that, as a value-focused manager, knowing what was happening in terms of momentum and growth in the market pre the COVID crisis, does that trend start to emerge again? Does that factor into your thinking?
Yeah, so that's why it was really important at the early phase of this to make be aggressive when the opportunities presented themselves in March, especially in March, is because at the back of your mind as a value investor, you know that the central bank's sitting there providing stimulus and people are using any valuation methodology to justify anything, and you can, so to speak. It doesn't mean it's the right investment, but that's what was going on. So as a value investor, pulling the trigger when the opportunities are in front of you, when you thought things were trading at a 50% discount, you had to act pretty quickly. So we're of the view that we've done enough in that we've bought the right things at the right time, that it should outweigh those elements, and that there are going to be some winners. There are going to be some structural winners out of this and some structural losers. And as a value investor, for us, more importantly, is to try and avoid the structural losers, because you get attracted to valuation, and then occasionally you buy things where the earnings go backwards for the next 10 years, but the multiple's the same. And that's usually for a value investor, you've got to try and avoid that sort of investment case, because it can be quite devastating to your portfolio. But we're of the view that we've sort of positioned our portfolio in two distinct camps: those long-term winners that provide a real short-term opportunity to get set, and some of the deep cyclicals where you're going to get a recovery and the market was overestimating how bad it was going to be.
Can you go into some more detail on those two, few examples of some of the stocks that you own in those two camps that you've outlined there?
So obviously with the Perpetual Investment Company, we can buy some offshore stocks. So we doubled down on our Flutter investment. It's been a good investment, but I remember in March it had fallen 40-odd%. Obviously there was no live sport. Given it's an online sports betting company, 80% of it's effectively online sports betting. Obviously there's going to be a revenue hit, but we know the quality of the business. We know that gambling returns pretty quickly when there's... you got to remember, this wasn't an income shock for the man on the street. Given the level of transfer payments from government directly to the man on the street, there wasn't really an income shock at this level. So we know that gambling will pick up pretty quickly, but you'll be able to buy it. We were able to buy Flutter at half of what we could do in February. So we went pretty hard and we doubled our exposure to that one. Crown, another, it's been a core holding for us for a while, but it had fallen to a level down to about $6, $6.50, where you're getting the assets for basically a big discount. And these are monopolistic, city-based assets, run for a long time, and you're not going to get another one typically built in the same city.
And there'd been takeover interests in the past 12 months?
Yeah, so there'd been a couple of interested parties, and obviously, again, we doubled down on Crown as well, and you had Blackstone show up and take over the Melco stake of 9.9%. And if you look at Blackstone's history, they've done some transactions in North America on casino properties where they lift the assets out, and the management of the existing entity manages the assets for them. So we always thought that there was value in the assets, and such a discount to value of those underlying assets, we thought there was a real opportunity for us there. But then you have a look at, on the cyclical side, you had industrial metals, Oz Minerals, those sort of businesses, Iluka, they fell to such levels that the replacement value of the assets, again, were not called into question, but the market was assuming pretty bad outcomes.
So on that cyclical bucket that you're able to buy discounts, do they remain long-term positioning for the within the portfolios, or was that opportunistic style investing? There
is an element of opportunistic there, but some of like the Oz Minerals is a good business in general. It's hard to get copper exposure, particularly where they're growing their reserves, etc. And they've gone through Carrapateena. They've gone in the middle of the capex, nearly finished it, etc. Oil, especially, is another one where we put some money to work. Negative oil prices, I suspect, was quite stunning to most people. Whether it was real, I don't know. But it did provide, again, that noise provided an opportunity to buy some very cheap oil exposure. And energy's been on the nose for quite a while. So we still think there's some value to be had in a lot of those names.
Yeah. I was listening to a webinar recently, and you described corporate debt as the elephant in the room right now. Could I just get you to explain in a bit more detail what you mean by that and why it's something that needs to be thought about?
So, the 4 quality filters, we look at all companies through a decent balance sheet, lowly geared balance sheet is preferred and demanded by us. Just 'cause it does tend to keep you out of trouble when things like what we just went through occurs. It is interesting, up into February, market was at record highs. Companies were doing buybacks, borrowing money to do the buyback, leveraging up. And then once it hit, companies cancelled dividends, stopped buybacks. It was a cash flow hit, right? So we had complete cessation of all cash flow in some businesses. So then debt became a problem because you had to make your interest payments. So you're leaning on your banks to extend terms, etc. So it suggests to us a lot of companies that weren't preparing for a rainy day. Now, it's quite peculiar to us that a lot of companies actually went and got more debt rather than delevering this. Infrastructure, which is quite a defensive sector, but the corona was very specific to that sector in that travel had stopped and people were working from home, less movement, etc. So a lot of those companies, rather than delever, like Auckland International Airport, delevered. They did a raising. A lot of the Australian ones did not, and they've extended terms and put a bit more debt on. Now, the risk here is when you put more financial leverage in those assets, they're already highly financially levered anyway, because it's usually a stable business. What happens if you just ask the question, what happens if we don't return to normal levels for 5 years? All of a sudden, you've got more debt to service with less earnings compared to the last cycle. So all it does is introduce another business risk. And people tend not to consider it when rates are low.
So what you're saying is the response, this opportunity was to be more conservative. There's been low interest rates and the appeal has lent companies to go and get more debt, and it's just it's amplified the risk that was already within them.
Yeah, so they've thought, okay, this is a short-term event, so we need access to liquidity because cash flows dissolved effectively, so we need just access to liquidity, pay the bills, etc. For us, it's going to be interesting to see how it plays out, because if we don't return to pre-corona levels, I suspect there'll be some interesting conversations with the banks.
Vince, when I look back at the cash holdings that you had in the portfolio for PIC, pre and post-crisis, you pushed up towards 16% in February. Keen to understand what dictates the cash level. It's come back down. Obviously, you've seen some opportunities. You put it to work around 3% last time I looked. What caused it to get up to 16%, and how do you think about managing that cash?
So cash is sort of like a bit of an outcome for us. Look, we assess everything on both an absolute basis and a relative value basis. So when we're seeing better opportunities in the fund on an absolute basis, we'll deploy the cash pretty aggressively. And you wait for those moments. But in February, market was pretty heated, and we were really struggling to deploy the cash. You're having to make choices where something was less worse than something else. So I'd rather not make those. And in the PIC, we can go up to 25% cash. But also what we did is in January, the cost of protection was quite cheap because volatility was so low. So we bought some deep out of the money puts on the market, very cheap for us. And that extended, for a certain percentage of the portfolio, gave us a little bit more cushion. So when March hit, it gave a real cushion to the portfolio. So it's typically opportunity-led when we think about managing our cash levels. And we've got a big team internally, so we've got 17 people in the team. We're constantly scouring for new opportunities, whether it's domestically or internationally. And then you had the event, so there was value on. I said everything was on sale. A lot of the market was on sale. So, as you said, we went down to about 3% cash. That's how it drifted back out of it as we've started to take some money off the table and prepare maybe for some other opportunities down the road.
Wouldn't mind talking about a couple of specific areas in the Australian market. Some where you've had exposure, some where you've had none. Mm-hmm. Flight Centre, a company that was under extreme stress.
Yep.
And still hasn't fully rebounded. You participated in the recapitalisation of that business. Talk me through the thesis on a business like Flight Centre that's in an industry that looks like it's going to be so heavily impacted by travel restrictions.
So Flight Centre's always been within our quality universe. It's always the four: good management, good business, good balance sheet, and profitable business. So it's always been in our universe, but we've had some issues with some of the structural headwinds that potentially could occur. In particular, it can be a quite cyclical business. And when you're running a negative working capital business, when the top line falls, you can run out of cash really quickly. But it's a well-managed business. But they had to we could see they were making some choices to restructure the business. So what the Corona crisis did for them was it allowed them, and they acted, you could tell they had a plan ready to go. Because within the space of a week or two, they had announced an accelerated restructuring program, which when we looked through, it was like, that's exactly what they should be doing, spot on. And they acted pretty quickly, and then they said, right, let's buffer the balance sheet as well, let's build up an ability to make these structural shifts. So when we go through it, they're now really well positioned, I think, for the medium to long term, that they've set their business up to actually survive what we're going through now and probably be stronger on the other side as they've restructured in the right areas. So you take advantage of those opportunities when they arise. We've been looking at it for a while, and when the placement came about, it was a great opportunity for us to enter into the business because we'd already done the work. And we knew what they needed to do. But obviously having a management team that's been through it before, they've been through a few cycles. So it does help that they realise when there's a problem that they act pretty quickly. Mm.
That stock hasn't rebounded in the same V shape that the broader market has. Do you feel like there's unrecognised value there still?
If you're entering in at the placement price, it's rebounded quite well because it's obviously doubled. So that's our first position in the stock. So we think there's still value to be had. But from here, it's going to take execution on the restructure and some tailwinds from a recovery in global travel. So it's what I talked about, a medium to longer term, but there is value to be had in Flight Centre still.
Yeah. So let's talk about exclusions, A-REITs, and property. What's your view on that sector? I mean, there's I think you didn't have an exposure to it pre-COVID, but things get so cheap. Is there a price that everything gets on the table and is worthy of a consideration? Talk me through the thesis on rates.
Given low rates, as you said before, it is one of the sectors where the thirst for yield, everyone had an allocation or parked money in REITs. We struggle with premiums to NTA on those things when rates are very low because it doesn't give you a lot of room to manoeuvre if something goes wrong. If discount rates go up, etc. And the economy was pretty buoyant, so everyone was assuming low vacancy rates forever in some of the REITs, and we sort of struggle with that because there is cycles. But actually, we've actually been investing in REITs in the last few weeks. So they become so cheap in that, look, there's definitely going to be a renegotiation and a resetting at some level in retail and maybe in office, I'm not too sure. But that's a conversation that's being had. But the way the market was pricing some of the equity was that it was going to be devastating, like 30% drops of NTA, and rental will fall by half, etc. It was pretty extreme. So the market was sort of giving you an opportunity to buy into the REITs. On a multi-year basis, I'm quite happy with some of the prices we've paid for some of the REITs we've been buying because I think we're going to make money, good decent return on investment over the next couple of years. So as you said, never say never. The opportunity arose because of the extreme moves, and it was, when you think of the sectors that performed the worst, it was energy, financials, some discretionary, industrial cyclicals, and REITs. And typically REITs would perform quite well in a sort of market meltdown, but it was such a specific event, the market turned pretty quickly. So yeah, you use those opportunities to add value when you can.
There's subsectors within the REITs. You know, you've got your office, you've got your retail. Have you been selective about the exposures that you want within the REIT universe?
We've been buying a bit of office. Our exposure is some office, and we've been buying a company which sits across a few sectors, not massive over others, but it has a developer in it as well. So we sort of suspect that housing is going to be one of the things the government's going to try and maintain some sort of stimulus, and obviously with immigration being really low, potentially for the next 18 months, 2 years, you're thinking about the second order impacts on housing and development, but we think that the owner-occupied market will probably dominate most of that market in the next few years. And you can see the programs the government's sort of bringing about, from direct transfer payments to individuals to being a bit more targeted to sectors to sort of stimulate that growth. So yeah, we've been very specific. We're not really in retail exposure at the moment. Our preference is for office and something that's a bit more broader than that.
Look at the recent performance in PIC. It's been a good period. Obviously, you don't want to bank on the past returns, but it has, you know, last few months have been particularly strong. Aside from things that have worked, can you talk me through things that haven't gone so well? And
a few of those.
Yeah, well, just talk us through some of the things that you know, maybe in the context of some lessons. Like, what are some of the things that haven't worked out so well that you've learned along the way?
So if I think about one of the offshore stocks which didn't work, so Lloyd's Bank in the UK, you know, big retail bank, multiple brands in asset management as well as insurance. And the thesis there was looked very cheap to us, and given the conditions, we could see a change in the conditions of the underlying economy. So you had years of austerity in the UK, and you had a Brexit where there was complete uncertainty, and then in the space of 6 months to 12 months, you had a majority Conservative government get voted in, whose mandate was to grow the economy and spend some money, go very anti-austerity. And Brexit was effectively cleared up. The deal's going to get done at some point, and there'll be a bit more clarity on the other side. So, you know, you could see that the UK economy could really re-accelerate its growth from just removing one of the handbrakes, which was austerity. So Lloyd's is like right in the centre of that. It's a retail bank, and you can see how they managed through the period of really soft trading quite well as a bank. And we're sort of through most of the regulatory issues regarding mis-selling, etc. But when a crisis hits, funnily enough, and this is, you'll find this in all banks and financials, is correlations of global financials go to 1. It didn't matter if you owned a bank in the UK, the US, Australia, or Europe. They all traded exactly the same. So your investment thesis, the original investment thesis, went out the window pretty quickly. So that's one that hasn't really worked. Another one which hasn't worked for us has been event hospitality. Again, a hotel, cinema operator in Australia, complete travel lockdown, no one's moving around, no business travel as well. So it can be quite extreme. That's an extreme hit for a business like that. But, you know, it's a high quality business, great assets, all on balance, a fair chunk of them is on balance sheet. Really good management team, very good management team, and a good balance sheet to sustain some subpar trading for a while. You know, that's one of the stocks we added to in the sell down because it fell quite a lot. It fell almost 40-50%. So that's a really high quality business. It didn't work, but I'm pretty confident about the long term for that business.
I think we get cinemas opening in July, so maybe a positive tailwind.
Yep.
Outside of the individual, stock stories you've talked through there, you know, each crisis is a little different. You've probably invested through a few in your career. What are a couple of lessons that you've picked up from investing through the past few months?
I know nothing about epidemiology, but that's all right because everyone became an overnight expert basically. So it didn't really matter whether you knew about that at all. Because the second thing I learned is to have a plan when things go wrong, right? And that revolves around your investment process. Have an understanding of how you're going to act, what companies you're looking at, that when they get to your valuation levels where there's enough of a discount, and our team went through every company and worked out, right, worst case scenario, what's the valuation, take 20% off that. If there's enough margin of safety, we should be buying these names. Because at the time, there was a lot of noise, but no real information. So you had to rely on your investment process to sort of get you through. And as I mentioned before, pulling the trigger is the hardest thing to do, particularly in that environment. And we're all decentralised as well, so information flow may not have been as well good, but we worked through it. So what I learned was to have that plan before trouble sets in, because it'll get you through. It'll get you to make some decisions, which in a couple of years you look back on going, that was actually a decent decision that we made.
Can you tell me, how did it feel in those moments, pulling the trigger on some of those investments when there was so much noise and so much uncertainty? Can you recall the guts?
Yeah, it was an interesting period, because you're going, if this goes longer than I think, this could be a career ender. But we've got a pretty robust process. And I said, you've got 17 investing professionals to rely on. So you defer to the team, you're trying to do a few things at the same time, and everyone was working in the same direction. So it actually became a lot easier. You freed your mind a bit when you had a team looking at all the angles on particular stocks. So it allowed us to be a bit freer in our decision making, and we, again, you pulled the trigger. But it was difficult at the time. I can remember in the third or fourth week of March, you had to make some choices.
Great. Well, thanks for your time.
Thank you.